the new year is a milestone for each of us individually, but for 2017, it also brought an important milestone for the investing world, the closing of one of the last remaining open outcry exchanges. In this morning's U.S. Bank Economic 360, U.S. Bank Vice President and Senior Portfolio Manager Mike Denneman is here to discuss this event and what it means for investors. He's with Business Courier publisher Jamie Smith in the studio. Gentlemen.
Thanks, Peg. Mike, thanks again for being here.
Good morning.
Let's start at the beginning.
Yeah.
What is an open outcry?
Sure. So really, it's just a term to describe trading securities where the traders are face-to-face. And so most people probably aren't familiar with the term, but are vaguely familiar with the concept, having seen it on TV or in the movies. Really, it just looks like a bunch of guys standing in a circle. They're waving their arms and they're yelling at each other. They're standing in what's called a trading pit. They're wearing brightly colored jackets to sort of stand out in the crowd. And really all they're doing, though, is trading securities back and forth. So despite how chaotic that appears, it's actually a very efficient way of making a market. It's been refined over hundreds of years. But like everything else, trading is becoming more and more automated these days. And as computers do more and more of the trading, humans less and less, the need for the trading pits, it shrinks.
What exchanges have stopped using it?
Right. So the one just here in the last couple of weeks was the New York Mercantile Exchange, or the NYMEX, which is a commodities exchange, deals in energy, so like oil and gas, metals, and it's a long-standing exchange. It goes back to the late 1800s. And so, like many exchanges, for most of its history, it used open outcry trading, but recently has found that as more and more of the volume has come from computer-based trading, the need for the humans in the trading pit, again, it becomes less and less. And so many exchanges like the New York Stock Exchange that still have open outcry are basically hybrid systems where there are some humans, but mostly computer-based. And as that volume shrinks for the open outcry, eventually some exchanges make the decision to just do away with the pits altogether.
Okay. What's the impact, or what does that mean to the investor?
Like just about anything else, it depends on who you would ask. Some say it's well beyond time to move to 100% automation, that computers are faster, they're more efficient. Why really do we need all of these people in the loop when we can do the same thing by simply pushing a button? On the other hand, some will say that, it's actually open outcry more efficient than it looks. It's a very orderly way of making a market, in that there's an intangible benefit to having humans involved, that through experience they can sort of read the market and the mood of how things are going and can adjust accordingly. And of course, we all know that computers are not infallible. We've seen in recent years, in fact, where computer-based trading has created glitches that have disrupted the market fairly significantly. So there's valid points on both sides of that argument, and depending on where you fall, though, I think the writing is pretty much on the wall. Automated trading is not going to diminish. It's going to continue to grow, and that will only put more and more pressure on open outcry. So not many trading pits remaining, and those that are probably continue to shrink going forward.
Well, as always, thanks for bringing us interesting topics that you never think of if you're not there in the pits. So
happy to be here.
Thanks so much.